The crypto markets are in the red, but the macro markets are signaling green. In this video, I know it's been a while, we're going to cover an in-depth macro update. I'm going to give you guys my full picture on my current view of what's going on in the markets and all of the macro things that's affecting crypto prices right now. All right, so this one's going to be pretty jam-packed. Definitely want to pay attention. And if you have any questions, put them in the comments. Subscribe if you get value, like, comment, and share with a friend. All right. So before we get started, we have to say none of this is financial advice. And if you're interested in joining our free community, go ahead and scan that QR code. All right, let's jump straight into it. All right, guys, so here we are at the Crypto Fear and Greed Index. This basically covers, overall market sentiment. As you can see right now, we're in extreme fear. And given what happened, we actually hit the highest level of fear that we've ever hit since this chart was created in 2023. All right, so you know what they say. You want to buy when there's blood in the streets. And right now, the streets, there's a river of blood in the streets, guys. This low of a fear just means it's a lot of capacity for greed, right? If we look at the crypto ETFs, we can see that pretty much since January 15th, there's been mostly outflows of Bitcoin and Ethereum in terms of ETFs. So we had on the 25th, we had some inflows. On the 1st, we had some inflows, but then after that, things crashed, and we've just been seeing mostly outflows. 272 million in outflows in Bitcoin, 14 million in ETH, followed by 545 million in Bitcoin, 79 million in ETH, and $432 million outflow, 80 million in ETH. And now we're kind of having a relief rally, and we're going to talk more about where I see things going here as we look at the charts. Now, if we look at the central bank and balance sheet, we've seen a small uptick here, which means the central bank is buying things, injecting liquidity into the market, which is good. But there is a lag to this, guys. Just like inflation is down right now, but inflation is the most lagging indicator of all of the indicators, right? If we look at the M2 money supply, all-time highs, $22.4 trillion in the system right now. I'm sure it's more than that. And, gold has been operating like a stock, right? We saw it go all the way up to almost $5,600. Right now, we're sitting at just a little bit over $5K. And it looks like we're just kind of going to be consolidating around here for a while. But I think as, liquidity continues to increase, interest rates continue to drop, money's going to flow out of gold because things are going to flip to a more risk-on approach in how institutions basically allocate their portfolios based on market metrics, mainly interest rates and liquidity. We look at the S&P 500, we've kind of just been consolidating around all-time high levels, right? And I wouldn't be surprised if this started to break down, but I also wouldn't be surprised if it continued to go up. We got the Dow Jones Industrial Average at an all-time high. We got the NASDAQ at around all-time high levels, but it looks like it's starting to break down. We're retesting our 62 EMA as resistance. But, this happened many times, and you saw what happened. It just shot right back up. We got Coinbase down to $167 a coin. I'm really bullish on Coinbase stock. And if we look at Bitcoin, we went all the way down to $60,000, guys. 59 and some change, maybe 60,000. And you can see how much we broke market structure. We were in this channel for a while, but we broke out of it, retested again, and then broke our 62, retested again as resistance, and then boom. Now, let's talk a little bit about why I believe Bitcoin has been dropping a lot, which drags the rest of the market down, because Bitcoin is the horse that leads the race. And it's not just one thing, it's a combination of all these things. It's kind of like all these things on a scale, and after you add one more little pebble, everything just kind of falls, right? The market hates uncertainty, and these things I'm about to bring up is a lot of uncertainty. So the first thing is that we had the Clarity Act get drafted, and it caused a lot of riffraff between the crypto folks and the banking / TradFi folks, right? And the reason being is because, and a lot of it has parallels with the Genius Act. The crypto folks were mad, specifically Coinbase. They threatened to pull their support from the Clarity Act. And Coinbase has a lot of lobbying and voting and crypto power, so that's not to be taken lightly. Basically, in the Clarity Act, people were mad that stablecoins didn't allow you to pass on yield to people just holding the stablecoins. And before I explain the implications of that, there's a sector in TradFi called narrow banking. And narrow banking is basically a financial model that requires banks to hold 100% of their customer deposits in safe, highly liquid assets, such as US treasuries or central banking reserves, rather than just lending them out. Because right now, for every dollar you put in the bank, they can loan it out like 6 times, okay? And they don't have to pass on that yield to you. But narrow banking is what I just described. But narrow banks have never been able to get like fully approved. And whenever the Federal Reserve or someone big talks about it, they say the reason is because if the economy collapses or something bad happens, people are going to pull their money out of the normal banks where they know it's getting lent out, and they're going to put it into the narrow banks. And the narrow banks are going to essentially alleviate the other banks. And it's going to affect mortgages, right? And just affect the overall economy. Now, where does this tie in to the Clarity Act and the Genius Act? Well, the Genius Act basically made it legal for a narrow banking structure because in the Genius Act, you require it to hold the reserves in US treasuries, which is literally a narrow banking structure. But they just can't pass on the yield. And it's crazy because they do all this inflation, but now when there's a structure put in place to help protect the savers' savings, they don't do it. So, and Coinbase is threatening to pull out because that means that they'll probably have to shut down their yield product on Coinbase where you can just hold USDC on there and they pay you like whatever percent and they go and buy treasuries and Bitcoin and whatever they buy under USDC. So now Coinbase is pulling out because it's threatening one of their, bread and butter products. So eventually, and I think it's going to be this year, probably within the next few months, the Clarity Act is going to pass. They say it's not a good deal unless both sides are a little bit upset. So I think it still needs to sway a little bit more in the crypto folks' favor, and I think it will. Not sure exactly what it's going to look like, and we're going to talk more about why I think that is here in a bit. The second reason why I think Bitcoin is dropping is because the DAT treasury narrative is kind of dying down. DAT stands for digital asset treasuries, where you have companies putting Bitcoin on their balance sheet. That's been slowing down, and Bitcoin is a supply and demand market, at least to a certain extent, okay? And let me tell you what I mean by that. This is a big reason why Bitcoin was nonstop dumping for a while, right? I talked about it being supply and demand, but the more I went deeper, it's not just that at this point, right? Because what we're watching right now is not normal price action. It's not weekends, it's not sentiment, and it's definitely not retail selling. And I think most people are actually unaware that this is happening, and most people don't talk about it. And by the time it becomes obvious, all the damage is already done. The important thing to know is that this move didn't start today. It's been building quietly under the surface for months, actually. And now it's finally accelerating. So here's the truth. The moment supply can be synthetically created, scarcity isn't as much of a factor. And when scarcity holds less weight, price stops being discovered on chain and starts being set in derivatives. All right? And that's exactly what's been happening to Bitcoin. It's the same structural break that already happened with gold, silver, oil, and equities. And once derivatives took over, the original Bitcoin thesis kind of became broken a little bit, right? Bitcoin's valuation was built on two ideas. The first one is a hard cap of 21 million, and the second one is no rehypothecation. That framework kind of lost some steam the moment Wall Street layered this on top of the chain. Cash settled futures, perpetual swaps, options, ETFs, prime broker lending, wrap Bitcoin, and total return swaps. So from that point forward, Bitcoin supply became theoretically infinite, not on chain, but instead in price discovery, which is actually what matters, right? And this is called synthetic float ratio. And it's the metric that explains everything, actually. So once synthetic supply overwhelms the real supply, and when I say synthetic, I mean all those things I listed, the derivatives, price no longer responds to demand as much. It responds to positioning, hedging, and liquidation flows. Because Wall Street can now trade against Bitcoin. They're not guessing the direction. They're doing what they do in every derivatives dominated market. They're creating unlimited paper Bitcoin. They short into rallies. They force liquidations. They cover the lower side, and then they repeat. This isn't betting. It's inventory manufacturing, actually. Because the truth is that one Bitcoin can now simultaneously back an ETF share, a futures contract, a perpetual swap, an options delta, a broker loan, and a structured note all at the same time, right? That's 6 claims on just one coin. That's not a free market. That's a fractional reserve price system wearing a Bitcoin mask. Now, this isn't all doom and gloom, and I'm going to talk about how I see this unfolding here in a second, but I want to give you all this stuff in chronological order. Another reason why Bitcoin has been selling off, and as you guys see, the things are stacking up, so it makes sense why price went this low. You have OG Bitcoin holders who bought Bitcoin at 10, 20, 100, 200, $1,000, $5,000, $3,000, selling large amounts of Bitcoin. Why? Because they fear the 4-year cycle. And based off everything, they were kind of right? The 4-year cycle is based on the Bitcoin halvings. It rallies and then it peaks and then it drops. So a lot of holders of Bitcoin who hadn't moved any Bitcoin in a while took some profits, because even though it dropped down to 60, 70, they were still dramatically in profit because they bought in so early. Another thing came out the other day on the Epstein files, and they are basically saying that Jeffrey Epstein was Satoshi Nakamoto, and it's showing like timestamps and all this. I think that's BS, simply because a couple reasons. One, Jeffrey Epstein wasn't that well-rounded of a guy, right? If he did have something to do with it, which I still doubt, it was definitely a team of people, because in order to create Bitcoin, you have to know about game theory, you have to know about economics, you have to understand finance, you have to understand cryptography, you have to understand software programming. Like, a lot of things went into understanding Bitcoin. And I would be surprised if it was just one guy who did that. And I would be really surprised if it was Jeffrey Epstein. I think they released that and said that so that people can get scared and dump it, so that the smart money can fill their bags. Another thing that's scaring people about Bitcoin, specifically institutional investors, is the threat of quantum computers hacking the Bitcoin code. This is a real threat, and it is making Bitcoin more risky, which is making the institutional investors allocate less of their portfolio into Bitcoin. And Michael Saylor already came out and said that he's, starting up a task force to kind of help solve this problem, which is going to result in creating quantum-proof algorithms. And they're already starting to do that. I think they'll get it solved. And while the quantum threat isn't super close, it's also not super far. Probably a couple years if nothing's done about it. There's also been some conflict with the United States and Iran. Last year they BOMBED Iran, and they were talking about doing it again this year. But another thing people aren't really talking about is that the United States and Russia had a 50-year agreement on how much nuclear missiles and weapons that they can have. That just expired like 4 days ago. So that's scaring a lot of people too. So it's actually a pretty crazy time in macro right now. Like, it's a lot of things going on. All right. So now let's go through the rest of the charts, and then I'm going to talk about how I see the market turning around sooner than we think, and why. So if we look at Ethereum, we can see it went down extremely far. And this is a really good time to buy Ethereum, just because I'm going to zoom out to the weekly. You can see that anytime Ethereum was at this level, other than this period right here, it was a good time to bounce back. So it's not going to be unheard of for it to go. Obviously, it's Ethereum. It's going to go back at least to, around 5,000. And I would say within the next 6 months. So from here to 5,000 is 35% return. I like this for ETH. I'm not going to say we'll never see ETH at this price again, because I thought that here and I thought it here. But you can see it's few and far between. You got a touch here, touch here, touch here, touch here, touch here, right? A couple times in a year we've gotten these touches, okay? So I like ETH at this price. You can see that the total crypto market cap went all the way back down to 2.3 trillion. And we're actually going to come back to this chart because I want to talk about something important. We got stablecoin dominance increasing, which means people have been selling altcoins, getting back into stablecoins. The higher this is, the lower altcoins are, right? That's Tether. Same for USDC. And if we look at the ETH to BTC ratio, it looks like it's starting to fall over a bit because ETH has been correcting more than Bitcoin, but I'm still bullish on ETH over Bitcoin in the next year to 2 years. Now, let's talk about going back to the total crypto market cap chart. I want to talk about why I think things are going to start smoothing over soon. Guys, the important thing to know is that in the last bear market, it took us 24 months for $2.2 trillion to leave the market. And now we've had $2.1 trillion leave the market from October. You see 4.1 trillion down to now. So 4 months versus 24 months. So I don't think we're going into a bear market. I think we're about to come out of one. Let me give the reasons why. First thing is that we're getting a new Fed chair in May as Jerome Powell's term is up. All right. And a lot of people think we're going to get Kevin Warsh, who's Donald Trump's right-hand man. And while historically he's been viewed as an inflation hawk, he's expected to align with President Trump's preference for lower interest rates, possibly cutting rates another 2 to 3 times this year alone. All right. And, we all know if rates are getting cut, capital is cheaper, more people are borrowing money. The more money people borrow, that money needs to find a home. It's going to make its way into asset classes. We just looked at all the other markets. They're pretty much near all-time highs. Crypto is the only one that's like bleeding out. Crypto looks good. It's asymmetric, which means higher upside, lower downside. Another thing is we have midterms happening on November 3rd of this year. Let me tell you a few reasons why this is good. First, governments tend to stimulate ahead of elections, right? Historically, administrations want the economy to feel good as we're going into midterms. And this is because voter sentiment is closely tied to inflation's market and employment. Now, that often leads to looser fiscal policy, softer rhetoric towards markets, and pressure on regulators not to rock the boat, right? So risk assets, including crypto, usually benefit from this kind of environment. The second thing is regulatory hostility often pauses or softens, right? In election years, especially midterms, aggressive enforcement actions become politically risky, right? And lawmakers want to avoid the headlines that suggest that they're stifling innovation or hurting retail investors, basically. So for crypto, this often translates into fewer surprise crackdowns and more constructive language around innovation, jobs, and American competitiveness. The third thing is that crypto becomes a political talking point. So as crypto adoption grows, politicians increasingly court crypto voters, donors, and founders, which leads to pro-crypto bills being introduced or revived. Clarity Act, that'd be great. Clearer regulatory frameworks being discussed, and then public statements signaling support for blockchain, stablecoins, and financial innovation. And then markets tend to front run this perceived regulatory clarity even before laws actually pass. All right. And the fourth one, last but not least, markets historically perform well around midterms. Now, this isn't crypto specific, but it matters because historically the 12 months following U.S. midterm elections have been some of the strongest periods for equities. And if you look at crypto as a high beta risk asset, it often amplifies broader risk on sentiment when liquidity and confidence improve, especially how crypto has just bled out so much. Now, just again, we're going into a lower rate environment. Bitcoin was created in 2008 when they had just lowered rates. And it's been proven that Bitcoin is more correlated with liquidity than the halving cycle, right? So as liquidity continues to rise, we're going to see Bitcoin and crypto rise as well, especially as we get bills that passes it. Now, the question is, who's going to be the new buyers? Well, you've got sovereign wealth funds, pensions, insurance companies, family offices, pretty much the large institutional investors. It's a known thing that most of the money is operated by professional investors. And, I've been listening to a lot of people talk, Bitwise, for example. I was listening to the chief investment officer at Bitwise talk, and he was saying that a lot of these companies haven't even dipped their toes in the ground. And the Bitwise has like $15 billion in assets under management across all of their, exchange traded products. And he says that it takes around 8 meetings for them to start to invest a small portion of their portfolio into Bitcoin. And they normally don't meet within the same quarter. So that means it takes them on average 2 years to get invested into Bitcoin, and they haven't even dipped their toes in it yet, right? So guys, we have a long way to go. We're not going to always get the time right. Yes, I thought things would be up and to the right by now, but that's okay because DeFi allows you to just continually accumulate while things are down, so that when they do hit our price targets, it's a matter of when, not if, things are going to be looking good. You hear that? You hear how that took off right when I finished? I'm going to leave that part in there. So I'll end it on that. If you got value, like I said, like, comment, subscribe, share with a friend. Scan the QR code to join our free community. But with that, thank you so much for watching. I love every single one of you who tuned in, and I will see you in the next video. Take care and trade safe.